Good morning, traders. Today is Monday, the 22nd of March. My name is Neville Hornsey. I am a market analyst for YouTrading. I'm joined today by...
My name is Joel Frank, also market analyst at YouTrading.
How you doing, Joel?
I'm good. We were just chatting about the clock change coming soon.
Yeah, exactly.
So I'm really looking forward to that. It's going to be nice to have an extra hour of light in the evening to just do stuff, really. And now we're allowed to go for a walk in the park with our friend as well.
Yeah, exactly. No, and spring has definitely sprung, so the world's starting to look a bit prettier, all the blossoms on the trees.
Definitely.
And yeah, fingers crossed that will be good for the markets. You know, everyone getting out and about, buying stuff, selling stuff.
You'd hope so. I mean, yeah, I wonder, I'm not really sure what the volume profile sort of normally looks like going through these months. I mean, I know that August tends to be a bit of a lull because everyone goes on holiday.
Yeah.
I'm not sure if it's actually going to change much though. But actually, here's what I think might change. This is me being hopeful, fingers crossed. I'm hoping that the good weather, just like it did last year, will naturally bring about a big drop in coronavirus cases in the northern hemisphere anyway.
Yeah, no, definitely. You have hoped that, as per most viruses that we do contract, like the kids have all gone back to school now. So any sort of bug that you would catch, you've kind of caught now, and they've got over it within the first week or so. And then, yeah, the good weather, hopefully, keep suppressing any other further. You don't generally get a cold in the run up to the summer. It's normally at the change, when the weather changes that you get another cold. But yeah, vitamin D, that's what we need.
That is what we need. I know, literally. Lockdown has not been good for vitamin D.
No, I'm very tasty.
Yeah, same. But yeah, I'm hoping that when the corona, because obviously Europe's going into a bit of a third wave now, which is obviously terrible news for them, but their savior's probably going to be the good weather, I would imagine. So hopefully, in May, weather starts really getting better. Coronavirus cases in Europe start dropping. Obviously, they're already dropping in the UK, USA. Hopefully, that's a good mix for like risk assets like stocks and risky currencies and stuff.
Yeah, no, definitely. Where do you want to start? Pull up a chart if you want.
We start looking at the dollar. It's been a bit of a choppy last few days.
So all I'm seeing is that we're pretty much exactly where we were last week when I spoke to you.
Yes.
We've run up in the past to this old support, now resistance. We're still below the 200 EMA moving average. It's consolidated in a range. It's popped out at the top of that little range over the last week or so. And if it was to travel any lower, I wouldn't be surprised. But I think we're still waiting for certain things to happen at the end of the month. And we're going to talk about the Fed speak that's coming, and any mention of banks and how they sort of disperse their sort of profits. That might have an impact on the dollar. But I think we're still trying to churn through the all the stimulus and stuff like that. There's just plenty of money in the system, and it's got to be put to use. So how the rest of the world views that is probably going to direct the US dollar itself, I would imagine.
Yeah, I think I agree. I mean, for the dollar right now, it almost feels like, for me, I think the main thing driving the dollar recently has been bond yields. So if bond yields continue to rally, I think the dollar stands a decent chance of getting through this 92 kind of to 92.50 resistance area and the 200 DMA. But that, like you said, that is a big resistance. And if for whatever reason, perhaps the Fed comes out a bit with stronger language on taking a more hands-on approach to stopping bond yields from rising, then you could see the dollar drop from here, because like you just pointed out, there's really, really strong resistance in this area. There are going to be a lot of long-term dollar bears who do see this as an opportunity to get short potentially. So
yeah, I mean, from what I can tell, not a lot changed over the last week since we last spoke, apart from we've got US and China talking and being a bit sort of standoffish at the moment. They're not like best of buddies, are they? So that's kind of the old trade war sort of theme. The SLR, the supplementary leverage ratio, is going to be ended at the end of March.
Yeah.
So that goes back to a year ago when the dollar was generally sort of coming down slowly. So yeah, I can't see a lot changing other than this yield sort of control curve control. So
yeah. But to be honest, though, I'll be honest, I don't think the Fed are going to come in with that more dovish language about stopping the rise in bond yields, just because they haven't really signaled much concern yet. And I mean, I'm just looking at the US 10-year at the moment, and it has been a bit spiky in the last couple of days, but I don't know. I don't think it's been rising at a pace that would make the Fed really uncomfortable, because I think for the Fed, it's almost there's not the level that they worry about. It's how quickly it goes from one point to the next.
Yeah, the order. They like everything to be in an orderly fashion. That's why they sort of give us the forward guidance. But also the bits of the Fed sort of general speak that I pick up is that they're happy to let inflation maybe rise above 2% for a period of time. They see rising yields as a sign of an increasing increasing what am I trying to say?
Well, it's a reflection of the improving outlook. That's
it. So they see an increasing positive outlook coming into the markets. So,
yeah, exactly. Like you say, like they almost look at it as like a good thing. So, and to be honest, I get why they would look at it like a good thing, because they do have this massive QE program that they are eventually going to have to unwind, or at least they think they're eventually going to have to unwind it. And actually, the higher bond yields go, the closer that and the lower bond prices go, that almost brings bond prices closer to their like fair value. Like imagine what their value would be without the Fed buying all those bonds.
Yeah.
The closer it gets to that value, the easier it's going to be for the Fed to actually get rid of that QE in the end. So maybe they secretly kind of like this increase in bond yields because it makes their job easier. I mean, I don't know, but that's kind of speculation. But
also, like, it wasn't so long ago that the yields, 10-year yields, were pushing 3%, and everybody was like, that's a mark in the sort of a line in the sand, if you like. If it goes above 3%, then everything like falls apart. And we're not there yet, so we're not that line in the sand. So yeah,
and even back then, it didn't really fall apart. Like it was. We saw a correction in the bull market back then. This was back in 2018, I think, wasn't it?
Yeah. But also, like, that happened maybe as a sort of self-fulfilling prophecy in certain ways. Maybe there's a little liquidity crunch at some point in the euro dollar market, but things didn't fall apart in total. So stock, just looking over the last 5 years, 6 years, 10 years of the stock market, it's basically been going up. So
I know. I think as long as the rise in treasury yields is orderly, like you were saying, then I think it's not going to concern the Fed too much, and it's not going to rock markets too much. But I think it's still, even if it's an orderly rise, it still could be supportive for the dollar, just because it continues to strengthen that US rate advantage, basically, over particularly like the Eurozone and Japan and even the UK.
Yeah, and I guess if the dollar was to sort of fall off a bit, then we might actually see crude prices go up a little bit. But at the moment, they're sort of, again, they had a bit of a sell-off last week, didn't they? So
yeah, that was crazy, wasn't it? That was about a 10% drop at the worst levels.
No, definitely. When you see it go from like $67 all the way down to below 60, it is finding support again. I'll just share the screen again. So yeah, I just marked off. I had like support at these swing lows before, and they basically just flicked underneath each one, sort of taking the liquidity, and they've paused at this little block here. Obviously, if this one goes for reals, then we're down back to $52. But because there's definitely a little void of volume there that just floated up. So yeah, this balance area here at 52 would be my next target lower, but that would be dependent on the US dollar rising. And as we just said, that may or may not happen yet.
And I think crude can continue to rally even if the dollar rallies as well. Because, like, to be honest, because when we were talking about crude last week, we were quite bullish, and obviously there's been a big sell-off, but I don't think much has changed for our reasoning to be bullish. Our main thing that like market commentators and stuff were citing for this correction that we saw in crude oil markets was the worsening outlook in the Eurozone.
Yeah.
And that obviously, in the short term, that is a negative for crude oil prices. Like France going back into lockdown, Germany's going to be extending its lockdown, Italy going to lockdown. Not good for short-term crude oil demand. But like we were just saying, coronavirus cases in the EU, fingers crossed, should drop off this summer, and they should be able to reopen just because of the good weather. And then that we'll be seeing that all over the world. So the EU will catch up with the rest of the world, and then we're going to see all this crazy demand for fuel because people will be driving and maybe even flying if they take the restrictions off international travel. So I still hold that bullish outlook for crude definitely for the summer and later in the year.
Yeah, and I guess maybe
things will be a bit bumpy.
Yeah, with the higher prices, the US fracking and shale and things like that come into play because they can actually afford to do that. You know, that's quite a thing. You know, that was the problem last year or the year before when, the US was like just pumping out tons of oil. Now you know, with a correction, it's just whether or not those producers can sustain their flows, I guess.
True. Russia will be loving this actually, because Russia love that price where they can make as much money as possible, but just not high enough so that the US shale does anything, basically.
Yeah, exactly.
So this is probably quite a good spot, around 60 for them.
Yeah, and as long as Russia and Saudi and all those guys can pump more and sell into the market, and there's demand for it, then they'll be happy with anything above 40, won't they? So these prices for them are really good.
Yeah. And I mean, actually, this little setback is probably good for OPEC cooperation, because if prices go too high too quickly, it's going to weaken the resolve of the cartel to basically be honest with its production. Yeah. Because the higher prices go, the more they're going to be like, wow, I really want to pump at these prices, man. Whereas now we're down, we're down 10% or nearly 10% on last week. So a bumpy road higher is probably better in terms of keeping them cooperative, I would say. Yeah,
well, since October, November, it's just been a straight line up, hasn't it? So it's healthy to have a 10% correction or a 20% correction, just so you can find where the sort of demand and the sort of support is. And with the emerging markets and the third world countries obviously trying to get their economies going after coronavirus as well, they don't want it to be too high. If it was to go to $100, they would just never be able to get off the ground, would they? So they wouldn't be able to afford to do anything. We wouldn't be able to afford to fill up our cars, until we get our economy back on track properly. So
but that's also something that actually stops crude oil from getting that high, though, isn't it? Because when it gets too high, it almost destroys demand for itself when it's too expensive. Like you just say,
it self-regulates, doesn't it?
Yeah. You'd hope. Because I mean, it's been at 100. It's been at 100 before, or it's even. How high did it get before the financial crisis? It was like 150, or maybe it wasn't 100.
The last price on my chart at the moment is around 110, and that was 2013.
Before the crisis, it went a lot higher than that, I think.
Yeah, but at the same time, it's it's in a place where 2015 traded here, 2018 traded here. This is like a reasonably good price, and if it wasn't for last year's dip below zero, then you probably would have said it's just at the sort of upper end of a range. So it's all good. I guess that reflects into the S&P 500, because that also had a bit of a sell-off last week, and we definitely saw it was such a frustrating week, waiting for the Fed to come out, because no one really seemed to budge their markets on the RBA. Everybody seemed to be waiting for Wednesday, and
it was boring, wasn't it? Monday and Tuesday were so boring.
And then yeah, and then we'll obviously have to wait until the evening for the Fed to, do the FOMC. And then there was like a move where I thought, okay, this is the market's repricing. And then to have it undone completely the next day.
Yeah. Yeah.
So
And then just destroy well, actually it got more than undone, didn't it? Thursday it took it.
Yeah.
Yeah.
So that big bearish candle would signify to a technical analyst that there's going to be a market reversal at this point. But we've obviously seen that happen quite a few times in this decade-long rally. So it might have just been a really good pullback to buy the dip. So because nothing really fundamentally has changed as of last week. Maybe come the 31st of March, the banks would have changed their sort of process a bit more, because by law, they have to stop the sort of SLR relief and things like that. So we'll see.
To be honest, the SLR thing, it's because bank stocks got destroyed on that.
Yeah.
But then again, I don't see why it would be a long-term. I don't think it's going to have a long-term negative impact on the stock market. It's a structural impediment. It's something we need to get through in the short term, but it's not. It doesn't change anything in terms of the big key drivers of the stock market right now.
No, for me, so the big ones are the interest rates as they are low.
Yeah.
Then I feel that's bullish for the stock markets. Then the dollar itself and the trade gap and the fiscal deficits, all to me say that's supportive of the markets. But the run up that we had from last summer till today, if you like, I felt that in April, when they did the sort of SLR relief, the banks were able to expand their balance sheets by allowing companies and investors and speculators to have a bit more margin, so they could then invest a bit more into, and they could put it into a higher yielding thing like the stock market. And now that's been removed. I don't think it's necessarily going to cause a market reversal because of all the bigger macro things, but maybe it will slow the pace, which means maybe we go sideways a bit more rather than just shooting up. Yeah, because if you can't buy on margin more and more and more, you wouldn't push the markets higher and higher and higher. You just hope to get more yield somewhere else, maybe. And if you've got the treasuries giving you yield, then maybe you go there.
They are rubbish yield though, aren't they?
Yeah.
They're still, I think the 10-year, I know it's what's it, about 1.7 at the moment, but in real terms, that's still deeply negative.
Yeah.
So TINA, there is no alternative. TINA is still very much in play, I think. But I hear what you're saying, and it could slow the rally, certainly could. But I think here's one thing though: we're so close to 4,000 in the S&P 500. Don't you get that feeling that the market just wants to hit 4,000?
Yeah, they want to hit 4,000, and they want the sort of the Nasdaq to go to 14,000, and they're probably going to want the Dow to go to 40,000 or whatever it is. I can't remember where we are now. It's just seems to go.
33,000, I think.
But they probably want 50,000. They probably you want to see those shots with the 50K sort of hats and stuff like that. Yeah. I remember when Dow 20,000 was a thing. Now that's just nowhere on the chart now.
Well, there's a point where you had to update your hat every couple of days.
Yeah, but also some people were predicting Dow 20,000, and it was to sort of coincide with the new president, the president that was coming in. That's when Dow would hit the 20,000, and then every 4 years it seems to be another 10,000, another 10,000. So it's crazy, but
it is crazy.
We'll see. Anything else you want to talk about?
Probably not, to be honest. I mean, we could talk about gold, but gold's just, there's not really much to say. I don't think. We're kind of range bound underneath 1750,
underneath the 200. Sort of moving average. Everything with gold definitely feels bearish currently.
Yeah, I agree.
If there's no inflation worries, then there's no need for gold, to sort of hedge against that worry. No one
I mean,
seems worried.
I think there is inflation worries, but I think the market believes that the Fed, if inflation does come, the Fed's going to be able to stop it.
Yeah. With the Fed, okay, like, there's no Fed worry about, the Fed's not like signaling this is a real problem. So
yeah, there's no worries that the Fed is going to lose control of inflation. Yeah. I think that is what would be really gold bullish, that the Fed would lose control of inflation. Yeah. Whereas the markets currently believe that interest rates are just going to go higher to tame inflation, and it will work. And obviously when real yields in particular go higher, then that's generally a negative, because gold doesn't yield anything, and these bonds, like, as soon as their yields go positive or higher, it kind of reduces the incentive to hold a non-yielding asset. You might as well stick it in fixed income and make some money.
Yeah.
But yeah, I mean, I know the Fed, I feel they're a little bit complacent at the moment. Some of the Fed speak I've read in the last couple of, years, to be honest, they think that it's them, because inflation's been low for the last 2 decades, really. Yeah, but
depending on how you measure it, but yeah, because
depending on how you measure it, CPI, let's call it CPI.
Yeah. That's definitely been low. Yeah,
that's definitely been low. Yeah, house price inflation and everything.
No. You try catching up with house prices.
Yeah, exactly. But it's the thing.
That's always a reducing. Like, hang on, it's costing more.
I know that it's like they don't put the price up; they just make your chocolate bar smaller.
Yeah, that's a health tax and inflation.
Yeah. But what I was saying, a lot of the Fed officials have, I think, they've been taking credit for the fact that inflation has been more sort of under control, compared to what it was like in the 70s or whatever. Whereas I think it's more to do with other things, like, like technological advancement, globalization, demographic shifts in like the age of
deflationary so far. Yeah.
It's all deflationary.
Yeah, the internet and globalization has been the biggest deflationary effect ever. Yeah.
Exactly. And I mean, I don't know. I think the Fed may be surprised that they weren't the ones that tamed everything, and then they might then struggle to keep things tame if things do really heat up.
Yeah.
But like we say, these disinflationary forces are still really strong. So I personally don't expect inflation to go really crazy in the next 5 years. But
yeah. So I guess gold then is useful for jewelry and a store of wealth. And at the moment, people are finding other places to put their wealth. There's crypto markets. There's all sorts of places where you can put your money to work. So maybe gold's not needed in that sense, but it'll be interesting to see if gold does get a new usage, like within technology or something like that, which would make it, in the same way as palladium or silver to a certain extent is being used more.
True. I mean, gold is a really good conductor, and it's been used in all those technologies. So I don't know.
And like, from what I can read, like the technology companies, when they're doing R&D, will use something like gold because it gives you like the best product in terms of most efficient product for doing that conductivity. But then as they need to like scale up and think, they try and find other means of conductivity, so tin and silver and the cheaper metals that will do the job, but maybe not as well. But
in every mobile phone there's like a couple of quid worth of gold. Like, I think in our iPhone there's probably about £2 worth of gold.
Yeah, well, in an iPhone you would hope it'd be like 800 quid's worth, because what else did they put in there?
I know, based on the price you'd be like, it should be made of gold.
It should be made, I want a gold one. But it is interesting to see gold not get any love at the moment, and other precious metals find some love, or at least hold up their prices. And obviously you've got the manipulation in, say, the silver market in the future, the futures paper sort of market. That's always a bone of contention. And we'll see if precious metals can find some love somewhere. But
I think the other precious metals, like you were saying, they do have more industrial demand. So like silver's been massively outperforming gold. And silver's probably got a higher correlation to, the performance of the global economy than gold does. Just because of that demand aspect. But I don't know. I mean, gold, you're not going to get I personally don't think you're going to get rich gold for the next like 5 years. But with gold, you've always got a sure store of wealth. Like you can buy gold, and in 100 years it's going to be valuable. Like
it's going to have some value, definitely. You can't.
Exactly.
We won't die and gold be worthless. Like. Yeah.
No, because it's always going to have, because unless
5,000 years has not been wrong.
Well, unless in 100 years people literally hate jewelry and just jewelry, just everybody hates it. But gold, it's always going to be useful. And I mean, that's my worry about these cryptocurrencies. Like, to be honest, like they're fun to speculate on, but anybody can just make a new cryptocurrency.
But then some cryptocurrencies have obviously been made and they seem to just die. So the ones that have longevity seem to be like sticky, like the ones that can find something. Yeah. So the ones that we know about, the ones that we talk about all the time, they've obviously been around for a while now. But,
But there's a lot. The reason gold is valuable is almost because of the laws of nature. Like it doesn't erode, it doesn't corrode, like all these kind of things. And my only worry with something like Bitcoin is there's no law of nature that preserves Bitcoin, really. It's just we're saying that we feel that it's going to do everything that we need it to do. Like we'll be able to transfer the money across the world frictionlessly. There'll be some sort of stock to flow, so that it would take longer to recreate all those bitcoins over the years, and it's going to get harder to make those bitcoins. So there's like a reduced amount of flow coming in and a demand that could be increasing. But if we all decide tomorrow, no, we don't want to use that, then it has you can't wear Bitcoin. It's like you can't wear gold. That's fundamentally my worry with Bitcoin. Like, because I think you're right, it is sticky and it's not going to just die overnight. And also, I don't think cryptocurrencies. I think cryptocurrencies are definitely the future. Like, of course they are.
But how much cash do you have in your pocket? Like, have you got like any?
Nothing.
So it's all digital anyway. Yeah,
it's all digital. So it might as well. It'd be nice if it could be something that wasn't abused by these central banks where they just print it willy-nilly. It'd be nice. I like the idea of these, like Bitcoin with it's got 21 million potential supply ever. But it's just that thing where I just worry that potentially perhaps maybe in the next 20 years or something, Bitcoin might be eclipsed by another cryptocurrency, because a lot of people are worried about how much energy consumption is required to maintain the Bitcoin network.
It's hardly a green currency, is it? It's like this whole green sort of deal.
It could be green. It could be powered renewably, but
from thermal energy in Iceland, that's one I've heard. That they actually get the energy out of the ground and then do their crypto.
But then couldn't you just use that energy for something else? Like, why do you need that much energy to do because I know there's all the calculations to do with proof of work that go behind it that make it secure, but I'm just not convinced that Bitcoin is the peak of cryptocurrencies. So I don't see Bitcoin as gold or digital gold, which I know is a controversial thing to say. A lot of people do.
No, I mean, a lot of people are putting their money behind Bitcoin because I guess the more people that do, the more demand there is, the more rich it gets. But it is a case of, I've always had the point of view, if I can't pay my taxes with it, then I don't want to get involved with it, because they could just cancel it one day. In the same way that America took gold off their population. They said you cannot hold gold, but then the rest of the world allowed people to hold gold. So you just moved your gold to Switzerland, or you moved your gold to England, but it's obviously a lot harder to move gold. Whereas with Bitcoin, if the UK say you can't use cryptocurrencies, then Turkey might. Well,
the thing is, how are they going to stop you? Because as long as you can make it so they can't prove that you've been using it, but there's ways to do that, surely. I don't know if the government's going to be able to stop it, but
the worst thing would be if the government give us a cryptocurrency and then just monitor every movement. Whereas that's when I want to be able to have gold in my pocket, or just like please like accept this currency, because I don't want the government to know that I've just paid my plumber. That whole sort of cashless society. That sounds worrying to me. But
it's creepy. I mean, I guess there's some noble incentives behind it, like because there's a lot of people that don't pay any tax and use cash for nefarious things, and obviously that would be a lot more difficult to do in a cashless society. But then, like you say, but then the other thing is, what if they just start imposing negative interest rates on us indefinitely?
Yeah.
Just we're going to take 2% of your cash every year. No.
2009, they were taking Russian money out of Greek banks and Cypriot banks, saying like, no, we're just going to do a big haircut. You know, wherever people had stored their money, that sort of place where it was held was just like, oh no, we're gonna just skim off the top of that account. Thank you very much. Like they can, and I know they can do that anywhere at any time because my money's in a bank and it is all digital as far as I know.
And it's eaten by inflation, but then negative interest rates is just like a nail in the coffin, basically.
Yeah, definitely. Horrible. All right. Well, fingers crossed. Next week, we haven't found any of that dystopian future.
No, got a bit on a bit of a tangent there.
But
next week, so what we're going to say. So Powell is speaking 3 times. So yeah, we need to listen to him. What's the other important events?
PMI.
So we've got PMIs out of Europe and the US and other countries. That'll be interesting. And then there was another one out of the US. Don't know why it's not come up on this calendar, but it was core PCE, which is the Fed's favored inflation measure. That'll be worth watching.
Yeah, that's a big one. Yeah. All right, great. Thank you for that, Joel. And
That's
I'll
mate.
catch up with you next week.
Nice. Speak then.
Bye.
Bye.